like there are some people missing. I'm sure they will join us later. Okay, welcome everyone. I am Francesco Rubino and I collaborate with B Entrepreneurs and ABSI. And today we are presenting a series of events. This is the second event of a series of events. The first one was on the 14th of June and was held by Francesca Oliva regarding social enterprises. And this second event will take care of another topic, which is venture capital and impact investing. The goal and objective of this series of events is to make the CSO, civil society organization, familiarize with this kind of topic, but also share knowledge. I think so, Chiara. Maybe Andrea will take care of your request in the meantime.
I didn't see her in the mailing list, so I don't know.
Actually, only the person who generate the event is able to see the full list.
Okay.
So I will ask Andrea.
Because sometimes she's missing because she didn't receive the email. Just this thing.
Okay.
Just to be sure that for LVA, she is the person in charge for this project.
Okay. And the person in charge for Andrea should be Elena Gatti.
Yes.
Okay. Thanks, Chiara.
No problem.
Let us know if there is someone else missing in your
It's
team.
for my project that is usually it's me and Elena, so it's
okay.
I always say this thing.
Okay, thank you. I was saying this series of events is to familiarize with new topics, but also share knowledge and ideas, but also trying to understand a new perspective, a new angle, and hopefully take these insights in our daily endeavors. Without further ado, I will leave the word to Gianluca Dettori, who will walk us through his career and his experience in venture capital and impact investing. Together with Gianluca, there is also Silvia Cacciapotti, who is also working for Primo Ventures and collaborated with Gianluca in designing this workshop for us. Gianluca, the floor is yours. Thanks again for joining us today and for finding the time.
And thank you very much. And let me introduce Silvia. Silvia joined our firm now it's more than a year ago. So maybe Silvia, you want to make a short presentation of yourself. And thank you, Silvia, for the help that you gave me in the workshop preparation, because I was really needed that.
It was a pleasure. Hi, everyone. I'm Silvia. I'm working in Primo Miglio since September 2019, so it's now 2 years, and I support the investment team, digital investment team, and the finance team in Primo Miglio. And it's a pleasure to be here and to join you in this webinar.
Thank you very much again. I'm really very, very happy about this. So let's see if I can do this. Visualizza a tutto schermo. Where the hell is that presentazione? Okay. So just quickly about myself, more because I like to kind of like give you the idea of what typically the journey of somebody that is into my position is, quite normally. So I was, in university, I knew what I wanted to do. I wanted to go into technology, and one day I had the chance to get into that with a job offer from Olivetti. So I've been a manager in the first part of my life. Then one day I quit my job and I did, fundamentally I decided to do my own startup. So I was an entrepreneur, and we were lucky to raise money and build a company, and it was quite significant operations. And after that, it was a ride. It lasted something like 5 to 6 years overall. After that, I took 3 years of vacation. I was kind of tired, and so I took a sabbatical. And in sabbatical, I decided that what I wanted to do next was to go on the other side, so go on the investment side of things, and enable in Italy a lot of kids or young generations that, like me, had the fortune, the opportunity to be entrepreneurs. And the opportunity was given by the fact that a venture capitalist believed in what we wanted to do with my partners and put the first money. And with that, we were able to hire the first people, build the product, and then raise more money, and then go to the stock exchange. It was without the initial 250,000, 350,000 euros, we could not have done anything like that. So being an entrepreneur for me was possible because of venture capital. At the time, Italy had no venture capital, there were no investors, and therefore I thought that I wanted to bring this practice into Italy. So I, with some friends and some partners, started to build up these investment operations, and now fundamentally we are a firm that invest regularly, and we have a very nice team of 15 people. And finally, we are now into a new phase, let's say, of our journey. This is part of us. Again, the team is growing very fast. So fundamentally, we work in the tech sector, and we help entrepreneurs build the companies that they envisage in their imagination and that they want to create. We specifically do venture capital in the so-called early stage sector. So that means really we are typically the first investor in with an entrepreneur. We do two sectors. We invest into digital. That's our legacy. That's where we come from. I've been 25 years in this industry, and as much as my partners as well. We all three of us built companies through venture, IPO'd, and so on and so forth. And then we have a new practice that after some years of development, we're finally able to launch last year and investing in the space sector. So we fundamentally have overall about 140 million right now under management. And currently the digital fund has completed its investment period. We have 29 companies. We're building 29 companies. While the space fund is just starting investing last year, we have now 6 space companies in the portfolio. So venture capital is definitely, we are, let's say, tagged and labeled into the finance category, but many of us, and me particularly, but many of my colleagues as well, we tend to we feel a bit stretched because yes, we deal with money, but fundamentally, that's not really what we do. We build companies. We enable valuable entrepreneurs that have big vision. And we typically, the journey for us of a fund is a 10-year journey. So we are now starting a new fund that I will be a partner of. And so, I'll be involved with this fund and with those entrepreneurs for the next 10 to 12 years. So it's fundamentally, we don't only put money, but most of all, what we do is we bring into these companies the stuff that we learned, the networks that we built, and the access to markets that we know, intelligence, ability to be financially, let's say, responsible and managing companies properly, and so on and so forth. And on top of that, of course, we operate under certain codes of ethics and values. In each one of us, we have our own, let's say, value, company values, transparency, things like that. And of course, now there's this big, important trend and pressure from the investors on top of us. You will understand better later what this means. But fundamentally, with the investors that invest in our funds, about the criteria for sustainability for environment, so the ESG criteria. Now, every new fund, fundamentally in venture particularly, that is starting right now has to start, have a policy about it, and it's more than that. So we need to provide to our investors, of course, a financial return, but they want us to track, monitor, and provide to them a social return. And the ESG criteria is, let's say, the parameter that right now everybody's using in the industry to find a way to track and measure that. It's a new world, and I think we're gonna have to learn a lot about how to use this. But anyway, so that's us. Let's skip this. Okay, so let's talk about venture capital, and I will try to keep as short as possible the presentation. so that we can have any conversation, question, or deep dive in any of these topics. So don't feel pressure right now to digest all this material, because it's going to be a lot, and of course the slides will be shared. So, well, first of all, again, we are labeled, so we are in the finance world. I mean, our job, my job as a partner of the firm is to build funds, which is a fund is a fundamentally is a contract, is a project that has certain rules and regulations, identifying a strategy, the sectors in which you want to invest, and so on and so forth. And then, how can I say, we invest in these funds, of course, personally all the time. And then along with us, of course, most of the money is put by other investors, financial investors. So we manage for them capital for 10 years into the private equity sector, which means we invest in private companies, which means we are not, how can I say, a trading company buying and selling stock on the market. We invest in a private company in an early stage, newly born, or sometimes about to be born new company. And particularly within the private equity segment, which is quite wide, there is private equity, that we are the small guys that do the venture capital. So this kind of high risk, let's say, on unproven companies, way of investing in private companies and startups fundamentally. So we invest in a very standard way. We always invest as a capital increase. So we put money into a company to fund a business plan, to fund a project, to find the entrepreneurs that want to develop this project. So we normally don't buy shares. So we don't, of course, we want entrepreneurs to invest their time. We put our money and our capabilities, but fundamentally we want to build together a company. That's the process. So it's not about buying your shares, but it's about believing in what you're doing and funding that. And we always take minority investments. We don't lead these companies. We are a minority investor. And in fact, we will talk about how we invest technically. You will see that fundamentally the contract is structured in such a way that fundamentally us being the weak part in the relationship, because yes, we put the money, but we have no control, or so little control over what's going to happen in the company. There are a set of rules in the investment agreement and in the term sheets that are standard globally that everybody uses, that kind of like build the right type of relationship between the investor and the entrepreneurs. And of course, again, this is just the beginning. It's about the money, but mostly what our job is about is being an active investor. I sit on the board of these companies and my partners as well. And we are fundamentally most of the time with our entrepreneurs, helping them, negotiating with them, raising money with them, trying to help them in getting to the market. Of course, in order to, let's say, continue what we do, we need to provide a financial return to our investors. Otherwise, they will not invest, and we will not have the money to put in the startups. So in the food chain of finance, just to tell you where, let's say, in our, let's say, private equity space, so before the stock exchange, let's say, that kind of world of investors, there is a food chain of investors. So you have to think that when a company is just a project, me and my two friends discussing one night at dinner about building a music company and what are we going to do, and how it's going to be decided, and what's the business model. So from the idea to the actual stock exchange, the company will go through different phases, right? And along different phases, you can find specific investors that are kind of like interested, specialized in being into that area of investing. So, and this kind of like is the food chain. So typically, initially is what we call the FFF money. So it's the money from friends, family, from FFF stays for friends, families, and fools. And so that's typically very beginning. It's your close network as entrepreneur. The first 10K to start, they come typically like that. Then there are the so-called business angels. So private individuals that invest the money that they earn, part of that money typically, into startups at the very beginning phase. Then we have venture capital, and there is us. So we are structured entities that have a lifespan of 10 years, that fundamentally have a capital design to invest in a certain kind of phase, sector, geography, and we'll talk about it later in certain phases of the startup. And then there is the big finance people, so the debt, the private debt, the private equity, and then the stock exchange. So along the different phases of a company, from being a startup to being a mature company, these are the different, let's say, rings in the food chain of finance. And this is needed, and obviously investing in different moments has different implications. The risk associated to initial investing is much higher than, of course, when you invest in later stages. But the values, also the how can I say, the impact that the money can have in building value, of course, is much bigger in the beginning than in the later phases. So if you were there, knowing the Google founders when they were in the garage building Google, and and you could invest there $10,000, then you would be a billionaire right now. So angel investor in Europe, and again, bear with me, but this is like the current, let's say, status of the Europe market. So I'm not, of course, translating this into Africa is a different dimension, but this is the current status of the European market. And actually, this is a bit outdated now. The numbers are going up, so the market is building up. So these numbers that I tell you, but fundamentally, just to give you an idea, so if you're raising up to 1 million euros in Europe right now, typically would go to angels, crowdfunding, family, friends, and fools, maybe accelerators. And then if you're starting to search for more than 1 million, then you will need to talk to seed funds or micro VCs that maybe you invest more than 1 million but can invest up to 2 or 3, or early stage funds. The typical investment is the so-called A round, which is the first, let's say, round above 1 million, typically in the range of 3 to 5 million. And of course, to be able to raise this kind of money, you as an entrepreneur have to kind of have a story to tell that, of course, not necessarily means about that you're profitable, but you have a story to tell in the sense that you have a business plan backing up what you're doing. You're actually doing some operations. You actually having some revenues, and you need this 3 to 5 million euros to kind of like make the first jump in terms of growth. And then there is a whole bunch of other still venture capital operators, later stage funds, all the way to the private equity world. And later stage, for example, is what right now is driving the big growth in Europe. There have been some very significant companies being built by European VCs in the last 10 years. Some actually are really very, very, like IUPAT has been probably the biggest story, but also the Spotifys and this kind of companies. So now we see a lot of later stage money, rounds of 50, 30, 70, 100 million. So from that point, it's not even more what I call venture capital, although it is actually, but we are more really on the beginning, on the entrepreneurs, on the grassroots, let's say, phase. Now, just maybe one thing that I need to say up front that maybe it's important to understand. So venture capital cannot invest in any small company. There are the limitation of venture capital that the way this way of funding companies is structured fundamentally forces you to having to invest in certain kind of companies. You can take any risk you want. That's not a problem. We can bear risk. That's what we do. But we need to invest all the time in teams that have the ambition to build huge companies. People that want to have a really big impact by building very big companies. It would take a little bit to kind of like tell you why this is. Just let me say, fundamentally, it has to do with the math of managing 10 years of a fund, where there is a high failure rates of your investments, and there is also the cost of time and the managing of 10 years of this fund and these investments. So, fundamentally, for a number of reasons, for making the math work in venture capital, the limitation is I cannot invest in a couple of guys that want to build a nice hotel on the beach in Sardinia. That would be a low risk investment, but it doesn't really scale. Unless these guys tell me, look, we want to build this first hotel in Sardinia, but then we want to build 10,000 hotels of this kind in the planet, and this is why, and this is because the market is like that, and so on and so forth. Then if that's kind of the story, well, then it's something that can fall into the scope of investment of venture. Now, I have to say also another thing, that venture is evolving a lot. So, of course, this is like, say, kind of like the standard, but there are quite a number of very interesting evolutions in the venture market that are interesting, particularly for what you guys are doing and what we are doing together in this program, and the idea of using venture for increasing impact on the resources that you deploy. So just another thing is, venture capital is a very standard sector business. Every firm works in the same way, is structured in the same way. The way we invest is the same. The practice is pretty global. We use the same type of investment contracts. I think they've been used in the last 15 years. Not much has changed there. It's the same contract that Steve Jobs signed when he took the money from VCs for Apple. The same that I signed when I was an entrepreneur, and the same contract that we sign with our entrepreneurs. It's the same. Let's say it's like the food is the same. It's the sauce that every firm makes it different. Every firm, every venture capital fund and firm is different in the sense that it really depends on where you invest, geographies. One thing is to invest in digital in Europe. One thing is to invest in biotech in Boston, and another thing is investing in impact, investing in Africa. It's really different. Of course, the geography, the targets, your investment strategy, the nature of the fund, the sector it invests, the story of the founders and the general partners of the fund. All of these kind of like so different sources make every fund different. So this is important to understand for entrepreneurs, because it means that you have to, as an entrepreneur, when you want to approach the venture market and you want to work with us, and there are thousands and thousands of VCs all over the globe, well, you need to understand who are the right investor you should target. So, if a biotech company sends me the business plan, I typically do not even respond to the email, simply because we cannot invest in biotech, and you can simply figure that out by going on our site or looking at who I am and what I do. And if you know how we work, which we suppose our entrepreneurs that want to talk to us, they do, then it will be very clear how to build your target of potential investors in what you're doing. Okay, so this is going to be maybe a bit technical, so I will try to make it simple. So fundamentally, so how does the relationship work between us as investors and the entrepreneur, and how this is kind of like forged into the investment contract? So first of all, we don't buy shares, we invest in the company, we invest in the project, we take a minority investment. So for us, in our strategy, typically is we typically invest €500,000 as a first investment in capital increase, and we typically target to subscribe 15 to 20%, 20% around of the company. But then we can invest along the 10 years in the same company another €8 million potentially. So we can support the company as it grows through the years. So it's a capital increase. Also, we have the right as a lead investor to have one person in the board, and that's typically going to be one of the partners. So if I lead the investment in the firm, I will also lead the board. And by being in the board, we take a personal liability. It's a personal responsibility. We are there on our personal, how can I say, we represent the interest of the fund, but it's our, let's say, it's us as a person taking the risk of being in the board and all what it means. And of course, the board is a bit regulated, means that, for example, we can veto through the board or in the shareholders meeting, we can veto certain extraordinary activities. So, for example, let's make one example. Let's say, you want to sell some important asset of the company, the brand or the database. Well, we have a veto right. So that means that we need to agree on that. So if we agree with that, then you can sell it. Otherwise, you simply cannot. Then we have some financial, let's say, clauses that tend to kind of like provide some, how can I say, protection. For example, the so-called anti-dilution. I will not go into that. It's a bit complicated in this context, but the liquidation preference is pretty easy. So, for example, we always have the so-called liquidation preference, which means, so we invest in the company was just born yesterday, doesn't have a customer, so it's just an idea. And we typically just imagine the scenario, we put $500,000 and we take 20% as a result of the capital increase. That means that the company has a potential value in our idea at this point, not even existing, barely existing, of something like, I don't know how to make the calculation, something like more than $1 million, how can I say, right? So this kind of goodwill that we kind of like is in our investment, and we believe in what you guys are doing, it's in a way as a protection in the liquidation preference, which means if things go well, I mean, you're going to have 80% of the company, you're going to have 20% of the company. If things go bad and we have to liquidate the company, well, the first money that comes back in will be the $500,000 that we've invested, and the rest will be shared among shareholders. So, of course, it's a weak, it's not a guarantee because, you know, sometimes there is nothing in this company that has a value, and therefore, typically, when there is a problem like that, you lose all the money. But anyway, there is this clause. There is there is one clause. Can you see the slides well? Hello?
Yes.
Okay, because I lost it for a sec. Okay.
No, yes, we can see.
Okay. The other thing that is called the tag along, which means you are the founders, you two guys have founded this company. If one of you guys wants to sell, well, you have to find a buyer that will also buy us out, which means, you know, we are here for 10 years. We would like you to be as well 10 years with us. And if you want to go and you want to sell, and you want to change your life or do something else, I mean, you can do it only under the condition that whatever coming in buying you out will buy us out, because we invested in the founders essentially. And so if they go, we want to go. The drag along, this is again a bit complicated, long story, but fundamentally, to make it simple, we have a right to sell the company, 100% of the company. There is a number of reasons for this. Fundamentally, the most critical one is anyway, after 10 years, I will have to close the fund in any case. So I will have to sell all the shares of any company that you have subscribed through the years. Of course, we don't do that the last year. I mean, the process of exiting goes through the fund, but, you know, we need to have a clause that can, you know, get us out of the investment after 10 years, you know, something like that. And then we have a number of other clauses in terms of, I've been committed, with the team committed. Because again, in these companies we invest, it's just a team with an idea, maybe a sort of an initial product, and have a customer if they're lucky, and everything needs to be built. And so we need to fundamentally make sure that we align our interest and the interest of the entrepreneurs in building value into what we are doing, in achieving the goals that we set in the beginning as much as possible. Of course, we all know that you start one way and we will end up in a completely another way. I mean, we made 50 investments in the last 10 years in 50 companies. I don't remember one that fulfilled the initial idea or plan, and even the success stories came out through bad times and difficult times and changing business models and so on and so forth. One interesting thing about venture that I want to tell you is that when I was young, venture capital was kind of like an art more than a science. Everything was new. It all started in the Silicon Valley. It all started in the tech sector, and then it spread out across the world, and it became an international practice with its own terms. But when I was an entrepreneur 20 years ago, I mean, we were doing things, but the science behind it was not really clear. I mean, we knew things that should have been done in a certain way, but there was no real, let's say, how can I say, science behind it. It was more like gut feelings, entrepreneurs and investors. In the last 10 years, 15 years, actually, though, this has become a real science. I mean, venture capital. So I will not, go into this. I hope you will discuss. I'm sure you will be talking about these kind of things. But I mean, in the last 15 years, there's been a movement of startups on a global level and a lot of thinking about this sector. So now this practice has become really much more accessible and can be taught much better. And I'm thinking particularly about all the world that started after the Steve Blank books and all the books that followed that, the Lean Startup movement, and all the terms and practices and way that have been developed that are really, really interesting. They could be very well translated into your activity and And I mean, I know that's exactly why we're here to talk about it. So here there's a number of terms. So now it's about what's the CAC. I won't go into this too much. I mean, I will if you have any questions. But there is what I would like to encourage to, if you're interested with these things, is to again learn more about the lean startup movement and read a couple of books. And there's a lot of information on the internet that I really suggest to go into if you want to again build these capabilities. So talking back about venture capital, let's say you want to talk to, another thing that I wanted to say is that, let's say the venture capital world is, in terms of investment sectors, is pretty clear divided into sectors. So there is, one big sector is the one that I belong to, which is the high-tech digital software sector. Okay, that's probably one of the bigger parts. Another big sector is the life science sector. So life science, all the medical devices and things like that. And also within that, biotech, which is all the molecules that bring pharmaceuticals into the market. That's another whole sector. There is a sector emerging in the so-called deep tech. So that's deep technology that can be used in various scenarios. So for example, for us, investing in space is a lot about deep tech investing. But also clean tech, all the environmental technologies that we're going to need to heal the planet and save ourselves in the next 20 to 30 years. That's a big emerging sector in venture. And there is another huge sector, which is the social impact venture capital. Many investors are fundamentally social investors, social impact investors. And just to give you maybe another data point, but again, you can search and you will find a lot of information on the internet. But if you go through, I belong to one organization which is called the Kaufman Fellow Program. I'm a Kaufman Fellow. So you search Kaufman Fellows and you go on the site, you will find something like 600 VCs in all the world. You can search by country, you will find me as well, in all the world and in all the sectors, and also where they invest and what kind of, let's say, scope of investments they have. You will find a lot of impact investors there with structured funds. I mean, the biggest one, of course, being the Gates Foundation in the US. But I mean, anyway, there is a lot of investors. I had a friend in my class in Stanford, again, at the Kaufman Fellow Program, that was working on a 200 million fund in Singapore or in Asia. And with one LP, one person, one investor, a very successful entrepreneur, 200 million to do what? Of course, to do a venture capital fund, so provide a decent return. Decent return to us means, these days would be 8% per year for the 10 years. So that means 100 euros invested in the first year of the fund means that we need to give back to the investor to provide that return 180 euros after 10 years. So that's kind of like a 2x in the portfolio on the money invested. But what was really interested into is water. This fund was investing only in water, how to bring water to Asians, and his bonus and the so-called carried interest, and so fundamentally what the manager would work for 10 years was fundamentally driven by the KPI of the impact metric. So how many people will be having fresh water because of the companies we've invested into? That was the metric that they were tracking for 10 years, and that his bonus and all his work was attached to. So those kind of venture funds are kind of peculiar because they are, let's say, for-profit impact investors. So they are all these kind of investors, and many of our LPs, so the people that invest in our firm, in our funds, so the institutional investors, they all have this idea of double returns. So they want double returns, means they want a financial return because they're investing money. There are alternative, let's say, less ethical way to put money, but they bring, again, returns. But they want the returns. They will need to. They want to have a sustainable, also, let's say, way to put their money into time. But fundamentally, they are keen. They are okay with getting less money, less returns. So it's not the only metric, while the other metric is the KPI, the impact KPI. And again, each fund has its own specifics, its own metrics of impact and focus of investment. So whenever you look at a fund, whatever fund, even a fund like that, typically the story, the roles in the firm, so that you know who you need to talk to if you're searching for money or for money for companies that you are working with as a mentor, is there are the GPs. The GPs, I'm the GP of the digital fund. What does it mean? It means I invest my money in the fund and fundamentally with investors. I manage the fund with my partners, and the relationship between us and the investors, we call the investors LPs, limited partners. So the fund is fundamentally a contract relationship between us as managers, me, Franco, and Antonio, the three of us as people, as general partners, the investors, the LPs, and the investment firm that manages, let's say, all the operation. So the fund is fundamentally a contract between these three entities. So let's forget about the LPs for a second, but what's important to know for you is that the LPs right now are searching for impact, not only financial returns, and are searching for ESG coverage. And so, I mean, this is, of course, it's good news and brings some perspective that possibly they will grow the activity also in Africa. But anyway, so the GPs are the ones that actually take investment decisions. So you really need to convince me, Frank, and Antonio to lend an investment with us, with our fund. We decide, the LPs have no way to say anything about our decision, so we are free to manage. It's like we have in our new fund, we will have a blank white check of 80 million, and we need to write who gets this money in the next 10 years. Fundamentally, that's the role, that's the relationship. Then there are venture partners, so they work around the organization, but they typically are consultants, but they do not take investment decision. Normally, the investment decision are in the hands of the general partners, so it's really the general partners which are the target. Then there is the team, associates, analysts, principals, depending on the level of the seniority that you have. These are very important, of course, because these are the operations of our fund. So, we receive about 1,000 business plans every year, and we make 5 investments. And then totally on the fund, we will make 25 investments and develop those through 10 years, right? So this kind of operation, for example, managing the deal flow that is coming in, identifying which are the potential investments that we should focus on, this kind of activity is typically done initially by the associates and the analysts, the investment analysts. And therefore, these are typically the first way to connect with the fund, with the venture operator. And then there are entrepreneurs in residence. Those are an hybrid form. It's typically people that are collaborating with the fund or the firm because they want to build a new company. So typically, what happens is that you fund a successful entrepreneur. He exits the company, he has some money, he has some time, and he wants to do his next company. Very often we work with these people. If they're good people, we like to work with them again. So, this typically is the relationship we build. Come here in the office, stay here with us, and let's identify together the right project where you can do your next potential investment. So with planning, is everything okay? I also don't see you because I'm looking at the slides right now. Is everything okay there?
If there is any question, I was watching the faces, Gianluca. If there is any question, please, guys, don't be afraid. I believe there is plenty of information to digest, as Gianluca said before.
Yeah.
So really, don't be shy.
If you want to, just stop me or ask questions, please feel free. I just remember I don't see you in your face because due to Google Meet, I only see the slides in order to show you this. So
we can do this way. You can finish your presentation. In the meantime, if you have any questions, please write them in the chat, and we can use the last part of the workshop to take them.
All right. So let's discuss a little bit how lending and investment works. So we receive about 1,000 business plans a year. That means we receive about 1,000 pitches per year. Of course, if you would send us a 40 pages business plan, we just cannot read that. We cannot read 1,000 of those to kind of like understand the ones we need to focus on. So the pitch is really is very important. It's a standard document. It's 10 to 15 slides, 10 minutes, and some Q&A time, so that in half an hour we can kind of like understand what we have in front of us. And so typically this is the stuff that you need as a first entry point to talk with any kind of investor, angel investor or fund. The pitch is a standard structure. Again, it's not about trying to explain what you're doing, but it's just to provide a number of information that are key for a potential investor to understand whether this is the right stuff that I need to look at. Because our problem is, let's say, quickly identified out of the 1,000 business plans, the 150 that we really want to read. And again, we know quite well our investment strategy, and the investment strategy evolves along the life of the fund, so it changes continuously. Therefore, we know what we're looking for, and therefore the pitch for us is important to identify those things that either we want to track for a potential future investment. Sometimes we work quite a long time with entrepreneurs before landing investment, not only because we like to know each other, but also because sometimes it's just too early for us to invest, and so we help them to get to the point where we can invest. And this is just happened before the summer in our last investment. It's a team that we've been following on and interacting with in the last 2 years. And we already liked them 2 years ago, but we told them that what we thought were the problems, and then we discussed along the way, and then finally that resolved everything, and actually they're going all right, and so we decided to make investments. So actually we know these people for 2 years. This venture capital business is not finance, it's a people business. It's about people relationship. It's about trusted relationship between LPs and GPs, and about trusted relationship between GPs and entrepreneurs. That's fundamentally what it is about. So the pitch is these 10 slides that helps us bring in the 1,250. Then 150 typically is the number of meetings that we would do in a year. So if a team gets into our office in a meeting, physical meeting, that means already, or in a virtual meeting, that means already very interested. I mean, it's already you're on the top 15% of interest for us at this moment. So it's pretty good. If you're already doing a second meeting, we are seriously interested, because again, that first meeting gives us enough idea to decide, what we need to prioritize in terms of the time to invest in due diligence. Anyway, we filter all of these with partner meetings and the staff and the team, and then we get to a term sheet. That means it's a non-binding document for us and the entrepreneurs, but we clarify to each other how the investment is going to be, how much money is going to be, when it's going to happen, what are the clauses. So it's fundamentally a non-binding structure that fundamentally can lead to the final contract. This document is important for us because then we can really start to invest in due diligence. So in actually spending time and money to look into the company. I mean, sometimes, not always the companies have been formed one day before. Sometimes we invest in a company that has maybe 3 or 4 years of history. So we have to look into the company, what happened, the numbers, fiscal issues, and so on and so forth, the due diligence, so-called. And then after this is completed, in the meantime, we define the definitive agreement, we sign the agreement, and then we call the money from the fund, and we put the money into the company, and we start working with entrepreneurs. Of course, after that, then we get into the real life of the fund. So again, the 10 years is the most of the work. So again, as I said, we, let's say for us, every firm works differently, but for us, for example, Primo Venture, each one of us, first of all, we create a team of 2 people that typically are dedicated to one company. Of course, each one of us has 6 or 7 companies, and one senior person typically would be a partner going into the board, and a more junior person that can support the activity, but also be informed and be ready to act and learn, in order to become a GP in the next years. So we support the management. We manage many times. We manage crises, problems. The money finished earlier than we thought. Keep people leaving. Somebody is trying to acquire us. Whatever. So we live the life of the company. We work a lot on fundraising. So whenever there is, let's say, further fundraising, we typically support very much the company in building the network of investors and lending investment. Of course, very often we co-invest as well. And then managing the death of the company or the exit. So when things go bad, fundamentally we have to close and liquidate the company. When things go well, then we start to work on exits, which means selling the company or listing the company on the stock market. At that point, we will be able to cash back the money and give the money back to the investors, and hopefully we will give more money back to the investors than the one they gave us in the beginning. And if that's so, we can continue this job. Otherwise, our career is over. So what are we looking for? As I was mentioning before, my mentor, my investor, the guy that I learned venture from, Serino Piol, was the CEO of a big tech company called Olivetti, Italian company, computer company, many years ago. And always told me one thing, that he personally made close to 200 venture capital investments in technology companies and startups. And he told me, I made 200 investments in my career. I always invested in small companies, but I never invested in dwarf companies. Ho sempre investito in piccole imprese, non ho mai investito in aziende nane, dwarfs. So that clears very well what we're looking for. When it was me and my two partners with our startup was called Vitaminic, going to Serino, we wanted to build the largest platform for digital music in Europe. And of course, we had nothing. We had a PowerPoint and our skills, what we knew, and that was it. And that's our every company in the space in this sector starts. If you look at every technology company that today is big, from SpaceX to whatever, there will always be a VC at a very initial point of the career of these entrepreneurs. This is how these companies are how can I say, built. So what are we looking for? So we are looking for this mindset. We are looking for game changers. We're looking for people that have high ambitions. We are not worried about taking risks, but we can only invest in projects that this risk is compensated by high ambitions. And of course, the ratio of startups is typically half of the startups die and the other half build companies that are real. And in that half, there are a few of them that become Spotify, Google, and so on and so forth. And this is how all of this works as a system. So first of all, then, after having said that, again, we search for certain markets. For us, it's digital and it's space. I told you, but there are also a lot of people that are interested in impact and in social impact. So the pitch needs to have certain information. What kind of market you want to go, how big is it? Who is the people that will take the challenge, and so on and so forth. We are looking for scalability, as I said before. We are looking for business that can be repeated and repeated and repeated in a very high scale. And this is, I think, what's interesting. Again, another interesting connection with what you guys do is that, if capital efficiency of venture is properly applied to social impact, the fact that we search for scalability means that if this technique can be translated, we can build very scalable impact projects where the scale of the impact is multiplied by very big numbers. And I think this is an interesting perspective. So anyway, we work very much on, we need to understand very clearly, have some ideas, or at least in the mind of the entrepreneurs, in us understanding it about, what the business model is going to look like, and, how they plan to generate revenues potentially. And again, of course, we know that this stuff is not carved into stone, that, plans are plans, but then when you go into the market, everything's going to be different. But then again, we need also to have a common ground to understand where the company is going, to be able to support the entrepreneurs, to understand clearly what the strategy is, and to also be able to support when we need to make changes. And these changes very often are critical. If you read some of the books that I was mentioning before, like Lean Startup from Eric Rice, you will find what's quite common in venture is what is called pivoting. Pivoting means you started with a certain idea, you went out in the market, it didn't work. Now, when it doesn't work, then it's a new investment decision that we have to take. So the thing is, okay, should we just kill it now, or have we learned something in the bad times that we had that can really kind of like change the perspective, and maybe we have understood something about the market that by changing our business model, we can then go and build the company anyway, just with a different business model. And what's interesting about this, the other book I definitely, always talk about that is worth reading, and it's very easy books, so quite also interesting, is Business Model Generation from Osterwalder, which fundamentally explains you how, in a very simple way, you can describe business model. But then what's interesting that once you can share this information, okay, in a very in this framework of the business model generation system, then we can also discuss about how can we change the things that are not working so that they work. What we call pivoting, okay? And okay, this is pretty much my slides. So I've tried to be gentle as much as I could. And hope you didn't find it too technical or too boring. And I'm here for your questions. Any questions?
Well, Chiara was asking about the books, and I'm gonna share it in a moment. You mentioned Eric Rice, Steve Blank.
Well, in general, I suggest to Steve Blank has a very big blog, every startup reads this blog. So, but the